and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Okay, the big question is, AI, is it a bubble? Everybody's asking that question. And here's what some are saying about it.
I used Alan Greenspan's phrase of irrational exuberance. That's what a bubble is. I said we certainly have exuberance, but nobody can tell you whether it's irrational because the possible impact of AI is so great that it may turn out to be justified.
Lie. And it's a big lie. Justifiable? How can it be justifiable? Think about it. 14 years, since 2008 to 2022. What did they do? After the crash, remember we got wiped out, about $8 trillion. The market dropped 54%. And instead of doing it the old-fashioned way, rebuilding the country by increasing investment into companies, machinery, and so forth, business investment. They said, no, let's not do business investment at all. Let's just bypass all that, and let's just get this market to crank up 1,200%, and the S&P 600%, and we'll do it by cheating. What we'll do is we'll print nearly $4 trillion, and what we'll do is take that $4 trillion, and the Fed, every time the market pulls back 2 to 4%, the Fed will go in and buy treasuries. And the minute they buy treasuries, the yield will drop. And you got a perfect setup to buy on dips. Which brings up the question today, you should be buying a dip today? Absolutely not. You don't have the setup. You have to have a QE setup. Because remember, during that time, 2008 to 2022, it was set up to buy on dips. You had a guarantee every time the market pulled back, it would rally. Because you had the Federal Reserve going in, making sure it would rally. Because when it pulled back 2%, 3%, 4%, they'd go and buy treasuries to push yields down. That automatically pushes the tech stocks, especially tech stocks, up. 14 years. But here's the bad part of it. Bubble? What are you, nuts? You got right now, and I talk about it all the time, we only have a handful of stocks driving that whole rally. When you had, if you think about it, going back from 2008 to 2022, that whole 1,200 point rally and on the NASDAQ and the 600 on the S&P, it was a handful of stocks, about 40 stocks, 45 stocks. That was it, out of 5,000 stocks. Or take 40 stocks out of the NASDAQ 100 and the S&P 500. I mean, are you kidding me? That's insane. That's terrible breath. That's dangerous. But remember what they did. They created a bubble, a specific kind of bubble. It was a liquidity bubble. And that's how we ran into trouble because of all that printing of money. By the time we went from 2008 to 2022, those years, we hit 9% inflation. You can't keep printing money and printing and have zero interest. That's what was going on. No interest. They just would give the money to corporations. They'd buy bonds. The Treasury buying bonds. Everybody's buying bonds. Get the yields down. Banks are buying bonds to get the yields down, to get everybody to buy stock. And that hasn't. And what happened when we hit 2022, we had 9% inflation. Everybody's going, "Well, you nuts? We got to stop doing this right now." And they did. So now they looked for a new narrative. So if you think of the first bubble, it was more, the QE bubble was sort of a liquidity bubble. Not sort of, it was a liquidity bubble. And then when the liquidity bubble, when they stopped that in 2022, because inflation was up 9%, they were looking for a new narrative. They needed a new story. And of course, they had the perfect story. AI. Let's do an AI. So the first one was a liquidity bubble. The second rally was a story. It was all storytelling. And they were talking about the AI clouds and the the semis and the data centers. There's going to be so much productivity. Which, by the way, the data centers right now, nobody's really making money who's investing in them. So no, this is a huge bubble. But remember, bubbles are very hard to break. You just don't go into crashes, and you got to have specific things to happen. And the big problem is, like now, from 2022 to today, 2026, we got all the gains are coming from 12 stocks, just 12 stocks, and they're all AIs, either the four chip makers, machine makers, or you got 8 companies that are buying the machines. You know them all. Micron Technology, Intel, NVIDIA, you know them all. I don't have to go through them. So it's so now you got, if you take the NASDAQ 100, you take the S&P 500, and you take XLK, which I like better than the NASDAQ 100, about 64, 70 stocks right there. Let's say 700 stocks. And out of the 700 stocks, you have a handful of stocks. 12. So think about it this way. You have 12 stocks out of 5,000. There's 5,000 stocks that trade during the day. There's only 12 stocks been holding this whole market up. So, but to have a crash, it's not that easy. You have to have things line up perfectly to have a crash. So, so regardless if it's crazy or not, the S&P's up 600%, Nasdaq's up 1,200%. We added 30%. Remember, from 2022 to 2026, we added 70% to the Nasdaq, 1,200%, and we added another to the let's see, the S&P was up 600%. We added 30% to the S&P. So we added 30% to the S&P, and I mean that's just crazy. So what are they going to do now? Well, you don't have to worry about a crash because we need a catalyst for a crash. And we don't have it. We need a recession. We need a major bank failure. Now, we're shorting the banks right now. My gang and I, we're shorting it. We're doing pretty good. Now, we've only been doing it for 2 days, but at least it's going in the right direction because banks are in deep trouble. Now, yields are really up. I think the yield right now is up at 4.4. And usually that's good for banks, right? They like high yields because they make money, but they're not making money right now. Because and what we need is a catalyst to get these stocks back down. You've got to get these stocks back down. To drive a stock market up 1,200% and 600%, that add another 30% and add another 70% over the next 5 years from here going back is nuts. It gets out of hand. You got to correct. Markets have to be corrected every 3-4 years. You got to correct them. You need a 10, 15, 20% correction to keep the prices down. The problem with the market right now, I can think of skiing. When you were skiing, you went skiing with your family 30 years ago, you take the whole family. No more. It's a sport for the rich. And the same thing with trading stocks. Okay? The prices are out of hand. The average guy can't buy a stock. It's too expensive. But going back to the crises, we need a catalyst. We need a recession. We need a major bank failure. We need credit spreads to blow out. That's the big one right there. Take the U.S. Treasuries, take those yields, and you take the credit spread between the corporate bond yields and the Treasuries. They got to blow out about 150, 200 basis points. We're at 88, so that's not going to happen. 88 is comfortable, so we don't have a credit spread as a catalyst to blow this market up. And then we got the other thing we have is yields. Think about the 10-year Treasury. We got to get that yield down to 3.5% or less. The yields are going nuts. They're going straight up. The yields are going crazy. They're going to the upside. So that's not good. We're not going to get a correction there. And so these are the things. And you need to have unemployment hit 4.5%. That's not happening. You need earnings to collapse. They're not collapsing. You need liquidity to dry up. That's not happening. So anything that everything we need to correct this market, which we do need a good correction, is not happening. So what people are doing is they're just trying to rotate from stock to stock, but the big money is what you have to look at. The big institutions, they're not rotating. That's the real problem. You take the 13 institutions that have about $18 trillion, they're the ones that fuels the stock market. They're sitting in the bond market. They don't want anything to do with the stock market. They know it's nuts. Buffett, look what Buffett said about it.
We've never had people in a more gambling mood than that.
I think he's wrong with that. It's not a gambling mood. What's happened is because we've only had 10 since 2022. I think we've only had 10 corrections in the market. And they're not, 10% or less. 2020 was the only time we had a 34% correction. That's it, 2020. So we're not getting a nice 25, 30% correction to straighten this market out. This is what we need. So the market will keep going up because everybody's in the same stock. The same 5 stocks, same 12 stocks. And as you know, they're the stocks that make the chip machines and the people who buy the machines. And when you think how crazy that is, that's insane, isn't it? I mean, you got 5,000 stocks that trade daily. You got 12 stocks, or just say 12 stocks out of the 700 that the most popular, the NASDAQ 100, the S&P 500, and XLK, about 64 of those stocks. So that's what's going on there. And the other thing I wanted to talk about, people are all talking about housing. Okay, they're all worried about housing. And but we're not having a bubble like we had in 2008. That was crazy back then. They never even looked at your credit scores. They didn't care if you had a job. That was just totally nuts because they're packaging all that garbage. Jamie Dimon should be in jail. He's the one who did that. They took all the garbage and sold it to investors in Europe and everywhere else. So we don't have that. We don't have that kind of a crisis right now. So there's not. I mean, the housing market is different right now. It's not the housing that's hurting people or the mortgage that's hurting people. It's the expenses that are around the house, the food, your automobile. Matter of fact, automobiles are in worse shape right now than housing. That's true. So again, housing is the least of our worries right now. I mean, Florida. I think here in Florida, bankruptcies on house are up maybe about 12%, but that's nothing compared to what it used to be. So again, the big thing is the housing stress is a different kind of stress. So in 2008, think about 2000, you had a $400,000 mortgage in 2008, a 30-year fixed rate mortgage. That was around 6%. So that payment on a $400,000 house was about $2,398. Today, the average payment, because interest rates are up to 7%, about 7.5% compared to 6%, there's about a $300 a month more, okay, in payments today. And so about $372 more you're paying than you did back in 2008. But that's not even hurting the people. What's hurting the people is not so much the mortgage rate, it's the insurance. It's the property taxes. It's the utilities. It's the consumer debt. That's what's killing everybody. So the house a lot of people have a real low rate. A lot of people are paying less than 4%. So no, we don't have a housing problem. What we have is we got an inflation problem. That's what the real problem is. And we got a stock market that'll keep going up until it doesn't. We got to have a catalyst. Until that happens, we just keep buying. Okay, so I hope this helped you a little bit with what the real story is about the market and housing. And I'll catch you here tomorrow, same time, same place, philsgang.com. Join my gang, free for 10 days.
Are you nuts?